Imagine your investments paying you a mini salary. Every few months, like clockwork, a notification pops up. Cash deposited, straight into your account. This isn't a dream. It's the power of turning your shares into a steady stream of income. This is the reality of dividends. When a company you own a share in makes a profit, it can either reinvest that money to grow or share a portion with its owners, the shareholders. That shared profit is a dividend. A dividend stock is simply a share in a company that pays out these cash rewards. These payments arrive on a regular schedule. Most companies pay quarterly, but some pay monthly, feeling just like a salary, while others pay a single, larger dividend annually. Understanding this frequency helps you plan your cash flow. Now for the essential math, kept simple. The first key number is dividend yield, which tells you how much cash you get back each year relative to the share price. For example, if a stock is Rs 100 tons and pays an annual dividend of Rs 4, your dividend yield is 4%. This is crucial for comparing dividend stocks. The next metric is the payout ratio, which is the percentage of profit paid out as dividends. A healthy, mature company might have a payout ratio of 30% to 60%, showing a good balance between rewarding shareholders and reinvesting for future growth. A ratio over 80% could be a warning sign that the dividend is unsustainable. This balance is key to sustainable growth. A company that can effectively reinvest its retained earnings at a high rate of return, measured by its return on equity, or ROE, is a powerful engine for both future dividend increases and share price appreciation. So, how do you spot a quality dividend stock? It's not just about a high yield. Here's a quick checklist. First, is the company consistently profitable with a solid dividend history of at least 3 to 5 years? Second, is its return on capital employed, or ROCE, strong, ideally over 20%? This shows it's excellent at generating profits from its capital. Third, are its debt levels manageable? High debt can eat into profits meant for dividends. Finally, and most importantly, does it have strong free cash flow? Dividends are paid from cash, not accounting profits, so a healthy cash flow is non-negotiable. Timing is everything. There are 4 key dates. The declaration date is the official announcement. The most critical for you is the ex-dividend date. You must own the stock this date to receive the dividend. The record date is when the company checks its shareholder list. And finally, the payment date is when the cash lands in your account. Now, a word of caution. The biggest trap is chasing sky-high yields. An unusually high yield is often a red flag that the market believes the company is in trouble and may cut its dividend. And dividend cuts are a real risk. If a company's earnings falter, it may reduce or eliminate its dividend, causing both your income and the share price to drop. Also, be wary of over-concentrating in cyclical sectors. Diversification is your best defense. Let's briefly touch on taxes. This is for educational purposes only and not financial advice. In India, as of our 2026 outlook, dividends you receive are typically added to your total income and taxed according to your applicable income tax slab. It's always wise to consult with a tax professional. A smart dividend strategy involves building a diversified portfolio. The core satellite model is a popular approach. Your core could be stable companies in defensive sectors, while your satellites could be higher growth companies offering a blend of dividends and capital appreciation. And decide what to do with the cash. Take it as income, or use a dividend reinvestment plan, or DRIP, to automatically buy more shares, powerfully accelerating the compounding process. So, here's a practical workflow. First, use a stock screener to find companies with a dividend yield in your target range, say 2% to 5%. Second, check that its payout ratio is stable. Third, verify its free cash flow is strong enough to cover the dividend. Fourth, ensure its ROCE is consistently high, ideally above 20%. Fifth, check its debt levels. Finally, look at the price trend and valuation. This systematic check is your shield against bad investments. For study purposes, you can often find these profiles in sectors like FMCG, public sector undertakings, IT services, and financial services. The key is to study their fundamentals, not just their names. Ready to start? Here are your implementation steps. 1. Aim to build a diversified portfolio of 8 to 15 different dividend stocks. 2. Schedule time to review your portfolio quarterly or semi-annually. 3. Consider using a systematic investment plan, or SIP, to build your positions gradually. And 4. Always have a separate emergency fund in place before you begin investing. The real secret to turning shares into a salary isn't a get-rich-quick scheme. It's patience and discipline. The pro tip is to find quality companies and hold them for the long term. Think decades. This allows the magic of compounding to take full effect. When you reinvest your dividends, you buy more shares, which then generate even more dividends. Over time, this virtuous cycle can turn small, regular payments into a truly serious and reliable source of income. That was a deep dive, but these principles are your foundation. Want a downloadable version of the Smart Investor checklist we covered? Hit that subscribe button and comment list for top Europe and US dividend stocks that you can invest in.